Hi, this is Paul Hitchcock with the Asset Protection, Estate Planning, and Business Planning firm BarthCalderon. Thanks for jumping on Wealth Protector TV. You may be listening on Wealth Protector Radio. And really excited to have a couple of guests here today. My colleague Brian Chou, who's a partner at our firm, expert in asset protection, estate planning, business planning, and Dan Whittaker, who's a managing partner and the owner and CPA for Whittaker and, I get it right, company.
You got it.
That's right. This is a great topic. What we're talking about today is entity structure for small business owners, closely held businesses, family-owned businesses. What are the choices? How is asset protection related to those choices? And then Dan is going to really get into the tax issues surrounding some of those entity choices. And I just want to have a discussion here. So thanks for joining. And Brian, we'll start with you. Small business owner, closely held business, family-owned business. What are the entity choices and some of the important differences between them?
Sure. So there's a number of choices. There are general partnerships, there are corporations, there are limited liability companies, there are limited liability partnerships, there are professional corporations. So there's a whole host of different options, basically alphabet soup. So,
right.
So yeah, there's a whole wide range of different types of entities that can be created.
So when you're sitting down with somebody who's either starting a business or maybe they have a more mature business and you're looking at it through the lens of asset protection, what are some of the issues that you're educating them about that they should have their thumb on the pulse of?
Sure. So I think the biggest thing, so most of the clients that come to us with an understanding already that having an entity is a good thing, because if you're starting from the baseline, a lot of people, especially the people who are less knowledgeable or less experienced business people, they'll just start and go into business, right?
This is a sole proprietorship.
Right, so they'll either show up as a sole proprietorship or even worse, they'll show up as a general partnership. And the idea here is, and what that means is, it means that they've just gone into business for themselves or with partners without forming any sort of formal entity. So they're just doing business as themselves.
And the problem with that is what?
So the problem with that, from an asset protection standpoint, and from a business standpoint generally, is when you're doing business as yourself, you're fully liable for all the actions of the business because you are the business. And so when you engage in business, if something goes wrong, that liability extends to not only the business and its assets and its liabilities, but also all the partners or the owners and their assets and liabilities. So for instance, if I own a coffee shop and somebody slips and falls in my coffee shop and I'm a sole proprietor, right, there's nothing protecting my house and my bank accounts, my investments, my other assets from the liability of the coffee shop.
It's wide open.
Right, and it's even worse when you have a general partnership because you're also jointly and severally liable for the actions of your partners within the business as well.
So you're having these initial discussions with business owners about the asset protection in the entity. And I want to ask you, Dan, what your process is like, because when you're meeting with these same people who are starting a business or have a more mature company, I mean, in a sense, you're in the asset protection business too, right? You're protecting, with tax. So how do you approach the issue from your side of that?
So the majority of our clients that we get involved with, they already have existing businesses, and hopefully a lot of the work that, a lot of the upfront work has been taken care of. But we do get into situations where maybe they don't have the right entity structure and they need to change that entity structure. And we really work with the attorneys on that to make sure that on the tax side we can structure something tax efficiently, but also looking at the legal side, right? Because we're CPAs, so we don't know. We may understand the legal side, but we don't set up entities. So working with folks like yourselves to structure the right entity type. If you look at a corporation now under the current administration is taxed at 21% federally, that's the lowest it's been, I can tell you, in the last 30 years that I know of. But when you layer that on with a corporation, if you take money out, you've got to take it out as a dividend, so it's taxed twice. And if you compare that to something like a limited liability company or an S corporation, that's only taxed once. So we really try to make it the most tax efficient as we can. Also understanding who the owners are going to be. Like as an example, if you have any foreign owners, you can't have foreign owners of an S corporation, but you can have foreign owners of an LLC.
Oh, interesting.
Yeah. And if you don't mind, I'm going to piggyback off of
Yeah.
Dan's point, which is, as an attorney too, we rely on the accountants to really understand the client, the ins and outs of the client's personal and business tax situation, because we're not boots on the ground doing the taxes. And so we will advise our clients on the structure of the entity, but it's always great to loop in the accountant and make sure that their input is taken into play from a tax perspective. So the takeaway for the audience is really, it's important to have not only a great CPA, but then also have a great attorney where they can work together, and vice versa as well. So
Is there ever a confrontation there? Because I imagine, Dan, with you, I mean, if you say, hey, if you do it this way, I can save you a lot of tax money, but maybe that's, not the greatest entity for some other reason. So how do you rectify that? Or maybe it doesn't exist, the confrontation. How do you do that?
Confrontation between attorney and
No,
CPA, or between
between somebody who wants to only focus on mitigating taxes, yet there may be another entity that's a better structure for them for other reasons
Yeah.
besides tax. Does that come up?
I don't know that it comes up that often. I can tell you, just being in business myself for the last 25 years and advising clients for close to 30 years now,
Yeah.
doing things from a tax motivated reason only is not the way to act. And I don't mean that like that's bad, but you have to look at all the business factors that are going on and really take that into account. And I don't know that I've ever seen us in a situation where we maybe butted heads with a client in that respect.
Right.
Because I think for us, it's, we give advice and we'll help you design what you need to do.
Mm-hmm.
And to a certain extent, you have to pull that trigger. And all clients are different. Some of them, some won't pull the trigger, and some need to think about it longer. I think that's just human nature.
Yep. Yeah. How does it work with somebody who let's say there's two partners, 50-50 ownership,
Yeah.
you're looking at the taxes for the business. Isn't their personal situation kind of play into the business tax scenario?
Wow.
And how do you manage two people?
Wow.
I think I struck a chord
yeah,
there.
you did. You struck a chord there for sure. That's something we deal with a lot. We've had clients that have been very simple, and when I say simple, maybe their business wasn't simple. Maybe they were running a $20-30 million a year organization,
Yeah.
and they had been a C corporation, and so that means double taxation. And then they've decided, hey, it'd be better if we were an S corp, and that's great because we avoid the double taxation, but they don't have the knowledge and the understanding to know what that looks like. And hey, if Joe takes out 50% and John takes out 50%, can't we just look at how much we owe on our tax returns and we just split that? And to your point, it's not the same. You really, from my perspective, you need to make governing rules at the corporate level of splitting distributions and making distributions on an annual basis to pay for taxes. So my example would be, let's say you're 50-50, and let's say you get $1 million this year from the business, and your share of the revenue, or your share of the profit is $1 million, and your share of the profit is $1 million. We can't pay your tax liability and your tax liability because you may own different things. You may have 7 rental properties, and you may be married with 2 kids and be younger, and that's a different situation. But what the business needs to do is say, okay, if your distributor share was $1 million and yours was $1 million, we're going to give you each 45% of that. So you get $450,000 to pay your taxes, etc. You get $450,000 to pay your taxes, etc. And if you guys have different tax situations, that's your own problem, if you will.
Okay.
And that's where you work with us to make sure that we mitigate taxes at the individual level as well.
Sounds like maybe your part of your role is being a counselor. There's a couple business owners to say, okay,
Yeah.
corporate governance is important, here's how you do that, and you step into that role.
Yeah, well, so we actually got into a situation with a client, a brother and sister that own a software business that's doing very well a couple of years ago, and the situation was that they had different withholdings on their W-2s. So it was an S corporation. It gave distributions to each of the owners every year, and then they also got very nice, very large W-2s. So
Mhm.
a lot of wages they were pulling out of the business. And the brother said, hey, I'm just not gonna have any money withheld from my paycheck. I'm just gonna have the company pay all the tax. And the sister, she and her husband was a firefighter, and she had a nice wage, they had the money coming in from the business, and she's like, oh no, like I need to make sure that my taxes come out of my paycheck every time, every pay period.
Oh, no.
And the brother was like, forget that, like I'll just have the company pay my tax, which that wasn't fair. So
Right.
that's where you need to get into a structure. If in this case, if you have an S corporation or an LLC, hey, we distribute 45% of the profit to cover taxes.
Yep, no, huge, and as Dan was talking, it got me thinking about, I mean, you and I have chatted a lot offline about multiple business partners and how you handle asset protection, because aren't they exposed to each other's liabilities? So how do you handle that discussion?
Sure. So I think for any business owner, right, especially if they have assets outside of the business,
Mhm.
having some sort of corporate entity is important. Beyond that, additional complexities can pop up when you're talking about partners, right? And so one thing to consider from an asset protection standpoint, and really more a business succession standpoint, is what happens if something happens to one of the partners, right? So just like how it's important to have bylaws or operating agreements which kind of create the constitution for how the business is to be run and how to resolve disputes amongst partners. It's also good to have a buy-sell agreement in place. And so a buy-sell agreement is almost like an estate plan or a living trust for a business. And what it does is it allows us to plan for unexpected things that can happen to the partners. So for instance, for example, if the two of you are partners in a business, you own it 50-50, it's a widget factory, right? You pass away, all of a sudden, right, your assets are now owned by your wife, who has no connection to the business. He's doing now 100% of the work, but wife is entitled to 50% of the profits. That's not necessarily fair, right? But at the same time, you would want to preserve your interest in the business so that your family can benefit from it, right?
Mhm.
So one way that you would deal with something like that is in this agreement that basically says, hey, if something happens, there's a life insurance policy that Dan holds on your life that pays out money. He's then obligated to utilize that money to buy out your wife so that he now has full control of the business and he can do all the work, but now your family can still benefit from the work that you've put in the business. So that's one example of how a buy-sell agreement would address potential issues that pop up with regards to partners, right? And it goes beyond that. It can be a very in-depth document, right? You can talk about things like partners getting in trouble, getting fired for cause, bankruptcy, right, incapacity, if you have a client that's got Alzheimer's or suffers a stroke, right, making sure that there are provisions planned out so that those things are set when things are calm, right, when people can rationally make decisions as opposed to, oh crap, my husband passed away, what do I do, right?
Mhm.
And then you're acting from a place of desperation and you're not actually acting rationally. So having those things planned out is hugely important. The other thing is from a structure standpoint, right? There are ways that we can insulate the business from the liabilities of the partners, because the focus to this point has really been how do we create that shield so that the liabilities of the business don't attach to the personal assets of the owners. But there's a second type of liability, which is liability to the owners themselves, and then that puts the business in jeopardy. For example, let's say one of the owners gets sued for sexual harassment, right, a la Harvey Weinstein, for example, right? That liability isn't coming from the business; it's actually going to the owner directly. From that, then the creditor will say, well, you have this very profitable company, we want your interest in that company. And so the other
Can they just grab it? They can get control of that?
They can. So it depends on the structure of the business. So if it's a corporation, right? Corporate shares are very easily attachable by creditors. So in most cases, when we have small businesses, especially small privately owned businesses, we will typically recommend an LLC versus a corporation, because LLCs are typically less easily attachable by creditors.
Mm-hmm.
And if structured correctly, you can actually limit a creditor's ability to unilaterally seize your interest in a business, but instead force them to only receive the ability to get the distributions that come out to the owner from
Got
the
it.
business. So that way the goose that lays the golden egg can still live and continue to function properly.
Interesting, very interesting. Dan, on your end, do you see, on the tax side, people getting like hit with tax issues or the authorities coming after them for taxes because they haven't been handling that properly, like when you go in and start assessing somebody?
We see very little on the tax authorities. We see very little audit issues, kind of across the board. I don't see that much anymore, and I'm not sure why that is. I think when companies are being audited now, it's the IRS is after specific items. There's not just a general audit anymore. Not that we've seen in the last decade.
Due to limited resources.
Yeah, it probably
Yeah,
is due to limited resources.
yeah.
You know, we had a client that's a large contractor get picked up for an audit year before last, and specifically the IRS is auditing subcontractor payments to make sure that the subcontractors are 1099. So the IRS does studies in certain areas, and that's really about all we've seen clients picked up in the last literally decade.
Is that a big issue that that was announced a ways back about the being a full-time employee versus a contractor employee? Did you get involved in that? 'Cause that was a big ruling, wasn't it?
Yeah, that was a big ruling last year, right? The
Yeah.
WX case, which was a California case.
Yeah.
Employment law.
Yeah.
Yeah, we try to stay away from employment law.
Okay.
That's
That's a whole another ball of wax.
Exactly. We really rely on HR attorneys to take care of that with our clients.
But it doesn't affect the tax scenario when you're advising somebody about how to treat an employee. It doesn't come up too often.
Well, as far as we are concerned at this
Yeah.
point, I mean, if you have somebody that's providing services for your business that in the same capacity of what your business does, so if you're a marketing agency and you have you're like hiring subcontractors to write copy or to do video editing or what have you, those really are employees. They're just in the new gig economy, they're gig employees. I think Uber is going through that same thing right now.
Yeah.
Right?
Yeah.
Versus if you were an advertising agency and you had a plumbing leak, you would call a plumber, and that would be someone who's truly a subcontractor.
Okay. All right.
And again, I'm not an attorney, but that's what we're seeing taught.
Right, so you're probably not necessarily advising them on the specifics, but you might say, hey, you're an advertising company, I see that all these employees are independent contractors, you might want to talk to an HR attorney or a
Absolutely.
labor and employment attorney.
Absolutely. Yeah.
Yeah. Interesting. Well, I wanted to pose a question to both of you here because we're at the season right now where it's deadline season for you.
Yeah.
I know you're going
It means
crazy.
he's a successful entrepreneur. He's able to delegate that stuff.
That's
and stuff
right.
like this.
That's right. Yeah, he's here. So what new tax law out right now? You're having deadlines now. Are there any sort of new issues you're dealing with, or things that are trending that you're having to deal with your clients? Now that things have changed a bit. What's going on?
So there's one thing that is definitely is part of the corporate tax rates dropping down to 21%, and then you've got there was not necessarily a similar reduction on the individual tax side.
Mm-hmm.
So there's something called QBI, or qualified business income, and that's something we're seeing a lot of where the IRS, since the corporate tax rate went down to 21%, they're trying to make pass-through income from qualified businesses at a lower tax rate too.
Oh.
And that's really created a mess of calculations, if you will, that requires us on our side when we're preparing tax returns, and especially even tax planning, kind of look at the type of business it is. Does it qualify for a QBI deduction? How does that calculation work? Can we balance it between S corp distributions and wages? And it actually becomes a quite lengthy calculation to do. But that's something that we've seen for sure pop up since the end of 2017. Things like opportunity zone, I know we talked about that a few minutes before
Right,
this.
yeah.
Clients investing opportunity zones. So that's the ability to defer capital gain, almost like a 1031 exchange.
Right.
What else? Those are two of the bigger issues that we've seen. One of the benefits that we've seen from the new tax laws is the bonus depreciation. So that's the ability to accelerate depreciation. So if you buy machinery and equipment, et cetera, instead of having to depreciate that over a useful life of, call it 5 years, 7 years, you can take that all in the first year.
Oh, okay.
So that's been a nice benefit for clients.
So if you are bringing on a new client, so somebody new, big business, do you have an initial onboarding kind of assessment that you go through?
Oh, absolutely.
What does that look like? I'm curious.
Yeah, so the first thing we do is we grab 3 years of tax returns, 3 years of financial statements. We benchmark the business against themselves as well as their industry, right? So what does that mean? That means taking their financials and lining them up, those 3 years of financials, and comparing them to themselves to see how they're doing, where they're strong, where they're weak, how's cash flow, how's the strength of the business. Just like a bank would, an investor, a possible buyer. And then we compare that to themselves as well as the industry, so we know how they're doing in their industry. And from that, we can really start to pick apart points that they need help. And that helps us provide, more than just tax and tax planning work. Because about 40% of our work is consulting, strategic consulting.
Right.
So that really helps us get kind of under the hood and help them determine where they are and where they're going. And then the tax returns, we always look at the tax returns and try to see how the returns have been prepared. Like, were they done well? Were there opportunities that were missed? I can tell you almost across the board, there's always opportunities that are missed. Sometimes they're small. Sometimes they're small. Sometimes they're big.
Right.
But there's typically opportunities that are missed. And
It's unbelievable. Even with the big business you're working with, opportunities are missed. People just weren't being proactive.
Oh yeah.
It's unbelievable.
Isn't it?
Yeah.
Isn't it?
It really is.
Yeah. So for me, one of the critical things that I would want to get across to business owners is having a good, strong accounting team. If you're running a $10 million, $20 million, $30 million a year business, you need a strong accounting team internally. And what we find with our clients at any of those levels, 30, 40, 50, 100, $200 million businesses, they don't have good accounting systems in place.
Interesting.
And so without good accounting systems, you can't plan effectively.
No. Yeah.
And that's where we see many issues. We have a new client that's about a $200 million a year food distributor, and they are using a DOS-based accounting system. And they actually prefer paper.
Jeez.
And when it's 3-4 months after the end of 3-4 months down the road that they're getting actually closed financials, it's hard to help. It's hard to help a business like that.
Right.
But they're really the ones that need the help.
Yeah, the most. Yeah. Sounds like a great onboarding process. Really digging in. I was going to pose the same question to you, Brian. Is what's trending right now? I mean, what are people talking about? Asset protection, estate planning, anything hot right now?
There's a couple of developments in the estate planning world. I mean, so the same laws that were passed at the end of 2017 made significant changes to the estate tax. So the estate tax is basically a tax that the government places on your assets when you die, right? And so that's based on essentially the value of the assets that you own at the time of your passing. And the current tax rate is 40%, so it's a significant tax, but the exemption that you can utilize to the amount that you can protect from this tax was greatly increased. So it was essentially doubled. It went from about $5.5 million to about $11 million, indexed for inflation. So, so the current exemption is roughly $11.4 million per spouse. What that means for our clients is one, there's probably less people running around with their hair on fire, because that's the kind of the nature of the reduction in the estate tax, right? So there's less people with exposure, so less people freaking out. But what this also is an opportunity, because the estate taxes are so high and the amounts that you can give away are so high for very wealthy families. It's an opportunity to potentially give away more assets to your loved ones or children, so that those assets are out of your estate and they can grow and appreciate for the benefit of your children or your grandchildren.
Shares of a company?
Yeah. So that's one strategic way that you might do some gifting, right? You might make a gift of a company or real estate, right? Into an irrevocable trust for the benefit of, let's say, your grandkids.
Can I jump in there? Because I know this is a place where I would hear clients push back.
Yep.
Well, I don't want to give my son Johnny 30% share of the business because he's in his 20s and just got out of college, and we can create whatever story we want about that.
Mhm.
So where I'm trying to lead you is we can give ownership of that, but does that mean I have to give up control if I'm the owner?
No, which
Okay,
is
so
great.
how does that work?
Yeah, so this can be done in a number of ways, but one way that you would do this is through the agreement or the operating agreement or the bylaws of the company, right? You can, if you're not giving away majority ownership, or you can structure it so that certain people retain control of the company itself. But even beyond that, we can also, if we're talking about from an asset protection standpoint as well, right? We can place those shares into an irrevocable trust for the benefit of the children or the grandkids. So this is a way that you can kind of segregate control and ownership, right? So what we're able to do is we say, okay, we place these assets, let's say that 30% for little Johnny, goes into a trust. That trust has an independent trustee. Let's just say that it's you, Paul. So you're either a professional trustee or you're a family member who we trust, who has sound judgment, right? So those assets are now held in this irrevocable trust. You're in charge of managing it. You have a legal obligation to manage those assets for little Johnny. So as distributions come out of the company, right, they go into this trust, and then the trust has instructions on what you're supposed to do with that money. But at all times, you're supposed to be using it for Johnny, according to the terms of the trust. So now what happens is we have a situation where little Johnny, as he matures, he doesn't have any control of those assets, but these assets are accruing for the benefit of Johnny. Right, so in the event that I pass away, that 30% interest plus all the future growth of that business has occurred outside of my estate, right? So it's not subject to those estate taxes when I die. Then those assets during Johnny's lifetime can be used for his benefit in accordance with whatever terms we set within the trust. But what's really cool is if somebody sues me, right, those assets aren't exposed to my liability. Right?
Okay.
Because I've given those assets away. It's an irrevocable trust, so I don't retain the right to pull the assets back into my name, so they're not mine anymore, right? The other benefit is, let's say little Johnny is not as, not that your initial thoughts about little Johnny were correct, and he made some bad life choices, now he gets sued, right? Furthermore, the trust can be set up so that those assets are not subject to his liabilities either. And so that's a pretty powerful way for us to accomplish a whole host of goals, right? We're killing multiple birds with the same stone.
Yep.
We're mitigating estate taxes, we're benefiting our children or our grandchildren, but we're still maintaining control of those assets, or we're retaining a higher degree of control of those assets so that we're not jeopardizing the business. And we're also protecting those assets from not only our liabilities, but our children or our loved ones' liabilities as well.
That get to the point that you were trying to get at?
Yeah, absolutely.
Yeah,
Yeah.
that's interesting. So there's kind of a layered diagram there, putting the pieces together.
Yep.
Yeah, interesting, very interesting. Well, listen, great discussion. I think we probably go on for hours here. Dan, thanks. Brian, thanks.
Yeah.
Thanks for joining, and we'll see you next time.